Mahesh Nandurkar joins us now. Mahesh, while the bulls today are saying inflation has peaked, FIs are back, earnings are okay, you're pouring cold water, my friend, all the excitement. 9th of August, your report headline, unconvincing market rally. Why are you spoiling it for the bulls?
Well, Nikunj, I think, we definitely all are enjoying the market rally, especially what we've seen in the last couple of months after a long period of almost a sideways or a downward movement. But I personally believe that what we've seen over the last, month and a half or so is actually a culmination of a very fine balance of various global indicators, particularly in the US. What has changed in the US over the last couple of months, I would say, is that one, there is slowly a belief coming into play that the Fed is not going to be that much hawkish anymore because the inflation seems to be, behaving better, and there are some initial signs of that from what we saw yesterday, and an expectation that there could be a slower rate of increase in the US Fed rate going forward. So that's one hand. On the other hand, there has also been that worry in the US about a severe recession, right? Hard landing. But the jobs data and some of the other economic indicators seem to indicate that, okay, the things are not that bad, jobs are holding up pretty nicely, etc., etc. At the same time, we have seen the DXY kind of depreciating a little bit, which is a good news for emerging market investors. So all of these 2-3 factors have worked together. Also, the bond yields, the 10-year bond yields in the US have gone down, bringing down the risk-free rates all over the world. Now, some of these indicators are actually a bit contradictory to each other. I mean, if we are saying that inflation is coming down, the growth is slowing down as per what Fed expected, then at the same time, the recession fears have also abated. So these are variables which usually work against each other. Right now, we are seeing a very fine balance of all of these, which is making the investors globally very happy, and we are seeing the rally. But I'm not so sure how long can this balance really sustain.
We are in almost the last lap, so to speak, of earnings season. And you're making a point that the earnings have started trending lower, and the Jefferies analyst has revised earnings down for 48 out of the 106 companies. Do you see this decline more like a 1 week, 1 quarter blip because of that commodity adjustment, or it could be a linear cut in earnings which could happen? Because there are two different things. I mean, 1 quarter market can digest, but if the earnings cycle is going to contract for next couple of quarters, then we could be staring at much more lower levels.
Yeah, so what we've seen so far is that after the June quarter results, the overall consensus has cut the Nifty EPS estimates by about 2.2%. And we are not completely done with the result season as yet, but as I said, maybe 80-90% of the season is now kind of behind us. So maybe we settle somewhere around 2.5%. Of earnings revision for FY23 on the downside after the June quarter result. And this is actually the highest earnings revision on the downside that we've seen in the last several quarters. In fact, just to remind you, back in the Delta quarter, which was June 21, the Delta quarter, we had seen earnings revisions downside of around 2.8%. And this time we are about 2.5%. So, I mean, just to put things in context, the earnings revision on the downside that we've seen this quarter is actually equivalent to the Delta quarter, which is slightly unnerving. I'm not too worried because a large part of these downgrades have been driven by the globally aligned IT sector, etc. The domestic sector earnings downgrades have been lower than 2.5%, but it's still higher as compared to what we've seen in the previous 5-6 quarters. And generally, from the behavioral pattern, Nikunj, if you see, analysts are not in a hurry to cut full year estimates just in the first quarter, because there are 3 more quarters to go, and there is usually that positive bias in most of the estimates, and the analysts usually tend to delay the cuts towards the second quarter or third quarter and not take any aggressive cuts in the first quarter itself. So keeping that behavioral trend in mind, My worry is that you will probably see more cuts going forward as well.
Interesting. Mahesh, hi, morning. So, given that, from the June recovery, one has seen a big sectoral churn in the market. It's been a completely new set of forces which has, led us to this 14, 17 odd percent kind of gain. Just wanted to understand what changes have you made in your model portfolio? Are there any underweight, reduce, or overweight positions?
Well, okay, I'll not be able to talk about particular stocks, but at the sectoral level, some of the changes that we have done, or some of our preferred sectors or underweight sectors are so on the positive side. We continue to be quite positive and overweight on the banking and financial sector. I guess that's pretty much a consensus call at this point in time. You will hardly meet anybody who would not be bullish on this space. So yeah, so we are a part of consensus as far as that one goes. The second sector where we have been overweight is autos. We actually have been having this overweight call on autos for nearly last 9 months now. When we started this overweight call, there were not that many people, but I think now more and more investors have come around to the positive call on autos as well. We continue to stay overweight there as we speak, particularly on the four-wheeler and the urban side of the two-wheeler consumption trends as well. We've also been adding some non-auto but consumer discretionary names as well. I think some of the select stocks in the internet space are beginning to look attractive. And we've also taken the cue from the fact that NASDAQ has also kind of started outperforming the broader S&P. And some of the tech names or the e-commerce names in India have also corrected quite a lot. So some selective names in that space are looking quite interesting as well. Thirdly, we have been seeing very encouraging result trends on the capital goods side. Some of the select names which have been companies that have been focusing on the automation, the ESG related, the waste heat recovery related capex. Those companies have done pretty well. So we've been adding to some of those names as well. Property, as you know, remains our all-time favorite sector. We have been bullish on this for long, continue to be bullish on that as well. So these are the sectors that we have liked, and some of the changes that I just outlined. On the sectors that we have an underweight call on, that includes materials. Which includes like cement and metals. We're also underweight on energy sector, and we're also underweight on pharma. So those are the 4-5 overweight and underweight sectors for us.
Interesting there, materials, cement, as well as energy and the pharma sector. Mahesh, I wanted to also understand your outlook. If you could delve a little bit deeper in talking about some of these tech stocks. You said select names look interesting at the current levels, also basis the fact that they've corrected and what we're seeing overseas. Would you be of the view that now, given the companies are taking a lot more cognizance on their path to profitability and not just a cash burn, that's being viewed as quite positively by investors, so the tide is definitely turning here?
Yeah, so as I said, I won't really take a very broad brush approach in that sector as such. But yes, selectively, what you're saying is right. Some of the companies are taking a path to profitability, or kind of revise down the loss guidance for this year, for next year. But what we also have to kind of wait and watch is that as these companies focus more on profitability and reduce the loss guidance, how is that going to impact growth? Because ultimately that is also going to be very, very important. And despite the correction, many of these stocks still trade at a very high multiples, and those multiples can be justified only if we can be sure about the long-term growth trajectory. So yeah, I think it's once again a fine balance between a path to profitability without really giving up too much. I mean, they have to give up something, but without giving up too much on the near-term growth. So I think both these factors will have to keep in mind. And yes, there are one or two names that are looking interesting from that side.
Mahesh, you made a very interesting observation that Nasdaq has started outperforming S&P. Now that interest rate fear, at least globally, is getting averted, do you see a shift back to all other growth stocks as well? Because if cement, materials, energy, these pockets are taking a back seat, so could this be back to the market, let's say what we saw in late 2021 or early 2022?
Yeah, I think clearly with the with the Nasdaq beginning to move up, and we are seeing some I wouldn't say victory, but some sort of success over containing inflation will bring the investors towards or towards the slightly sort of expensive stocks as well. But I think quality is still going to be very, very paramount. And that's also one of the reasons why we have been raising weight on the consumer staples as well. So most part of the last 18 months or so, we've been running with a very big underweight on that. But now we have raised that sector to a neutral, because while the multiples are still high, but I think that is still the sector. Consumer staples is still the sector where you still get growth visibility and a good quality sort of management and ROEs, etc. as well. And also, I believe that if you are looking at a slightly turbulent market conditions over the next 3 to 6 months, wherein you might get some negative surprises on the rate hike front by the Fed, or maybe some inflation front by the Fed, etc. I think the staples companies will probably be a good place to hide, because it also looks like the worst in terms of the commodity price pressure is now behind, and the June quarter result season broadly captures the impact of those higher commodity prices. Maybe some will be seen in the September quarter as well, but broadly it's behind. So staples, I think, would be a good space to look at from that perspective.
Mahesh, in lieu of your views on domestics, after the recent correction, are Indian domestic internet plays now getting a little bit more attractive?
Yeah, that's what I said, that a few select domestic internet names are beginning to look interesting, and as I said, that there is this greater emphasis being given on path to profitability, and I believe that will come at some cost of near-term growth, but not a whole lot. So I think that balance needs to be maintained. But yeah, I do agree that a couple of names are looking interesting in the domestic Indian internet space. Yeah.
Mahesh, what would be the view on the entire telecom space? You haven't spoken about that. Given the fact that we have seen some numbers come out, you had the spectrum auctions as well, which was hotly contested. What's been your assessment?
Well, so that's again a sector which has done reasonably well over the last couple of years. And I would broadly categorize that that under the broader umbrella of utilities sector, which we have as an overweight, and particularly on the telecom side, I think one of the sort of keenly watched event, which is the 5G bidding auctions, that is now behind us. And the worry always remains, going by the past experiences, that whether the players end up bidding too much. But thankfully it wasn't really the case. By and large it was pretty much on expected lines. So I think that one risk factor is now kind of behind. We've also seen now the benefit of the price hikes, the tariff hikes taken by the telecom companies now largely reflecting in the ARPUs as we speak. I think it's now completely there into the numbers. So we would be looking forward to the next round, the next leg of tariff hikes. I think that will be crucial to keep the sector profitability at the higher levels, and to meet the analyst estimates, because that's what the analysts are sort of forecasting. So yeah, so I think so we would need to kind of start to see some movement on the tariff hikes once again, say in a quarter or two. And we are hopeful that this will happen. But if that doesn't happen, then yeah, obviously we will need to take a relook.
Interesting. Thanks very much, Mahesh, for giving us a 360-degree view of the sectors that you're bullish and underweight on, as well as, of course, your outlook on earnings and the markets.